समझ नहीं आ रहा अपने सैलरी इंक्रीमेंट का क्या करूं।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स के एसआईपी का टॉप अप करा ले। दिस इज द राइट टाइम।
क्या? समझ में नहीं आया।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स का एसआईपी टॉपअप करा ले। दिस इज द राइट टाइम।
अब समझा।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to ThePrint. This is Bidisha and you're watching Economics. For decades, India has been told to tighten its fiscal belt, keep deficits low, rationalise subsidies, and let markets decide. And by and large, India has listened, often painfully, often under intense scrutiny from international lenders and rating agencies. But while India was being schooled in fiscal discipline, the world's second largest economy, China, was running one of the largest industrial subsidy programs in recorded history. And here's the uncomfortable bit. International bodies looked the other way. Today, a landmark new database from the Organization for Economic Cooperation and Development, the OECD, has put hard numbers to what many suspected. The database is called MAGIC, which stands for Manufacturing Groups and Industrial Corporations. It covers 525 of the world's largest manufacturers across 2 decades. And what it shows should reshape how every serious trade policymaker thinks about globalization, about competitiveness, and the rules that are supposed to govern both of them. Let's get into it. The OECD uses a striking analogy to explain what industrial subsidies do to competition. It compares them to doping in sports. Think about it this way. If an athlete wins a gold medal because they trained harder, recovered better, and executed their race plan to perfection, that is competitive advantage. That is the kind of competition the global trading system was designed to reward. But if an athlete wins because the state pumped performance-enhancing drugs into their system, covered the costs, and made sure no one tested them at the gate, the medals are real, but the competition is more of a fiction. That is exactly what the OECD is saying about subsidized industrial firms. The output is real, the factories exist, the goods are shipped, but whether those firms won on merit, that is the question the data forces us to ask. Let's look at what the data actually shows. In 2024, global industrial subsidies totaled $108 billion. That is the second highest level ever recorded. The only year that was higher was 2009, the global financial crisis. But here is the critical difference. In 2009, the ratio of subsidies to firm revenue spiked because revenues had collapsed. Companies were losing sales, so the same subsidy amount looked proportionally larger. That was indeed a crisis response, a mechanical distortion. What we are seeing in 2024 is structurally different. The subsidy to revenue ratio has risen to 1.3%, not because revenues have fallen, but because governments are actively choosing to spend more on industrial support. This is peacetime industrial policy. It is deliberate, it is strategic, and in many cases opaque. Now, this chart that you see on your screen is the headline finding, in my opinion, from this database. Chinese firms receive 3 to 8 times more government support than their OECD-based counterparts. 3 to 8 times. That means if two firms are competing for the same global contract, one operating on market terms, one with the state covering a significant portion of its costs, they are not really competing. One of them is running a rigged race. Now, the standard defense of this kind of policy is competitive advantage, the foundational principle that was first articulated by economist David Ricardo. That said, countries should produce what they are most efficient at. and everyone benefits from trade. But that theory rests completely on one critical assumption, that prices reflect actual productivity. When the state absorbs 10% of your production costs, the price you charge doesn't signal efficiency, it signals access to public money. The OECD's own econometric analysis makes this even more concrete. Approximately 22% of global market share gains by expanding firms between 2005 and 2023 can be attributed solely to subsidies. For Chinese firms, that figure approaches 60%. 3/5 of China's industrial rise over 2 decades is statistically linked not to productivity, not to innovation, not to superior management, but to government financial intervention. This is more econometrics and less of a political claim. Now, the question is, how does this actually work in practice? The OECD points to a mechanism that most people have never heard of: below market borrowings, or BMB. A BMB, a below market borrowing, is a loan provided at an interest rate that does not reflect the borrower's actual credit risk. Now, here is a simple illustration for this. Imagine a loss-making steel maker. On commercial terms, a private bank might charge that firm 9 or 10% interest, reflecting the real risk of lending to a company that is bleeding money. Now imagine the state bank steps in and lends the same company money at 3%. The steel maker gets its loan, the bank absorbs the risk below market rates. The gap, that 6 or 7%, is effectively a transfer from the financial system to the firm. It is a subsidy, but it never really appears in any government budget. It is not notified to the WTO, the World Trade Organization, the very body that governs global trade rules. It is for all practical purposes invisible. China's financial architecture, where the vast majority of corporate loans flow through state and policy banks, makes this mechanism exceptionally powerful and exceptionally difficult to detect. Because the fiscal cost is distributed across the banking system, it is not itemized in any finance ministry's accounts. The solar panel industry is the clearest case study of what happens when the subsidy machine runs at full throttle. In 2005, OECD-based producers, European, American, Japanese firms, accounted for roughly 80% of global solar module production. By 2024, that combined share had fallen below 10%. Chinese manufacturers had captured over 84% of global module output, a near complete reversal in 20 years. Solar is also identified by the OECD as the most subsidized sector across all 15 industries in the database. And the consequence is visible in the supply-demand numbers. Investment in production capacity continued well beyond current and projected global demand levels, with prices per watt collapsing so dramatically that by 2024, several Chinese solar firms were selling below their own break-even point. Now, in competition law, any domestic jurisdiction, if a firm prices its products below cost to drive out competitors and capture market share, that is predatory pricing. It is illegal. You can take it to court. There is a regulator with authority and there is a remedy. What happened in solar panels is the functional equivalent of predatory pricing, except the state absorbed the losses through subsidies. And there is no court with jurisdiction, no regulator with authority, no remedy available to the competitors who were driven out. As a result, module prices collapsed, Western and Japanese firms exited, and the world became structurally dependent on a single country for a technology that is foundational to the global energy transition. Do you think that's competitive advantage? I don't think so. I think this is manufactured dependency, with the losses underwritten by the Chinese state and the consequences borne by everyone else. But here is what the OECD data reveals that has attracted far less commentary, in my opinion. It is not just the subsidies in themselves that have broken global trade. It is also the collapse of transparency. The WTO notification system was supposed to be the circuit breaker. Every member country is required to disclose its subsidies. If everyone plays by that rule, trading partners can make informed decisions about countervailing duties, market access, and investment. In 1995, 23% of WTO members were failing to notify subsidies, and that was already a problem. However, by 2025, that figure had risen to 70%. 7 in 10 WTO members are not telling the full story. Now, when the rules are hidden, everything downstream, for instance, trade negotiations, investment decisions, and duty calculations, operate without adequate information. Markets cannot self-correct, governments cannot respond proportionately, and firms in compliant countries are competing blindfolded. For India, this has a very concrete implication. And one particular sector deserves particular attention: fertilizers. The OECD data identifies fertilizers as heavily subsidized by both Chinese and Russian state-backed firms, largely through those below-market borrowings we just discussed. These artificially cheap exports depress global prices, undermine Indian domestic manufacturers, and create import dependence in agricultural inputs. Now, for a country where farm gate costs directly affect the income of hundreds of millions of people, dependence on subsidized fertilizer imports from geopolitical rivals is not simply a trade policy problem. It becomes a national security problem. India's instinctive response, production-linked incentive schemes or PLIs, domestic solar, and semiconductor capacity directing public sector banks towards strategic industries is understandable. In certain sectors, it is also very necessary. But here is the risk. If India simply matches the opacity, if we run our own subsidy programs without the transparency the global system needs, we are treating the symptom rather than the disease. And we may be accelerating the very race to the bottom that the OECD data is warning against. India has historically advocated for rule-based multilateral trade from a position of relative economic weakness. Now that position has changed. India is now large enough and strategically important enough to set terms rather than simply accept them. The question is whether we will use that leverage wisely. The OECD has handed India a gift: hard evidence, a credible framework, and a platform. India should now lead a genuine, sustained push for subsidy transparency, not just as a procedural demand in Geneva, but as a stringent condition embedded in every bilateral trade agreement, every investment partnership, and every supply chain diversification discussion that we enter. If India wants to be the manufacturing alternative to China that the world is looking for, it must ensure that the competition it enters is transparent, it is measurable, and governed by rules that apply equally to everyone, including us. Now, the choice ahead is stark. One path builds a genuinely competitive economy on terms India helped define. The other replicates the opacity and creates dependency with Indian characteristics. The solar panel industry tells us exactly where that second path ends. No serious industrial nation should want to go there. Now, the OECD has done the hard analytical work. The evidence is now on the table. What India does with it in its trade negotiation, its industrial strategy, and its diplomatic posture will say a great deal about the kind of economic power we intend to be. Thank you for watching.